was published on the 25th of August 2024, and it was called The Open Letter. And it's called that because there is contained within this one a first draft of an open letter to Matthew Pennycook MP. I've actually spent the week refining that one, working with a couple of other people to do that, hopefully for distribution very soon. Landlords will be pleased to hear. We've got the approval of the NRLA, first of all, and we've got a few more people we'd like to get on board before we distribute it through all the channels that we can. But I'd really appreciate anybody seeing this who thinks we're on the right lines and we're politically going to get the right message across in order to get some traction with this, to put it in front of their local MP and also in front of Mr. Pennycook and possibly Angela Rayner, and anybody with political connections. I very much appreciate you reaching out to me via LinkedIn or similar platform, or leaving me a comment on here, and perhaps we can hook up and have a chat about what we're trying to do. So as you'll know, I like to start every week with a quote, and this week's was, "Your thoughts influence you, your words move others, but it is your deeds that will change the world." And that was from Machona Dilwayo, philosopher. So before I get started, I do want to say one more plug for the property business workshop that's coming up on Tuesday the 1st of October. We're covering exits with two main objectives. That's planning your own, first of all, which most people do very poorly in my experience. And secondly, it's understanding other people's exit plans, or often lack of them, and assist with them when you're looking to buy a portfolio or a business from them. You can help the vendor get what they want, what they need, what they deserve, and work towards a real win-win situation. Now, as always, with any of the workshops that Rod Turner and I do, it will be an action-packed, content-filled day. It's not a day to get you to buy another course or do this, that, or the other. It's a standalone day that's going to help you advance your understanding as a property business owner. So all you need to do is go to bit.ly/PBWFOUR. There are still early bird tickets available with a 10% discount before we go up to full price in a couple of weeks' time. And there's only just over 4 weeks till the workshop, so get booking, folks. So, welcome. Feels like autumn has started a little early. Some stubborn sunshine around some significant wind. And you know what they say, if it's not nailed down. Lots to talk about this week. So a sizable deep dive includes the open letter to the still new Housing Minister, Matthew Pennycook. And as I've already said, I'd love as much support in sharing, liking, commenting, sending copies to local MPs, tagging influential people into this if you're listening to it on social media, etc., etc. So I'm going to plough through my usual real-time market analysis that I lift from Chris Watkin's excellent work in this department. I was privileged enough to speak to Chris yesterday. We had a little chat, as we do sometimes. And what's the news in the real-time market? 34,000 listings last week across the UK, which is still maintaining that difference of more than 7% difference from pre-pandemic. Then net sales also outperformed, 28% higher than the equivalent week in 2023 and 12% higher than the pre-pandemic market. The average listing price also dropped below 400k for a UK property, compared to the average 2024 listing price so far of nearly 440k. So almost 10% below the average listing price for this year. Market looks like reasonable value, and there's historically a very small gap between the price of new listings and sales agreed, an 11% gap. It's often a bit symptomatic of August though. It feels a busier August than usual at the coalface, that is for sure. And there'll be more in the real-time market next week. As I whistle into the macro, there was so much macro last week, there was no time to look at the retail sales figures, which are important to understand consumption in the UK and growth in the economy, apart from anything else. And that's why we have to keep an eye on them. Then there's the ONS private rent and house prices indices that are a monthly release in a more timely fashion than they have been in the past. And they're the real truth in terms of having all the data on housing sale transactions, and by far the best data set on rental price movements as well. Over 500,000 rentals in the ONS database. So a very, very good representative sample of the private rented sector in the UK. Then we got the flash PMIs for August already. They were released on the 22nd, and everybody knows I'm a big fan of these. They've done us an absolute solid this year in terms of predicting growth in the economy, which seems to have surprised nearly everybody else apart from readers and listeners of the supplement. Now everyone seems to be climbing on that bus. The concern will be that Murphy's Law prevails and the wheels come off, but we're not seeing signs of that as yet. We will, of course, round up with the gilt and swap yields. So retail sales, they've been worryingly limp for, frankly, years. These are volumes of sales, right? They're not prices, to be clear. The tale of the tape's pretty simple. There was a panic slump when the pandemic started, an absolute tear upwards when people were stuck at home with furlough cash and nowhere to spend it in terms of socialising, hospitality, typical habits of a UK household, and a small resurgence around the end of 2021 in that last hurrah Omicron lockdown, and then suddenly, bam, down 6.4% year on year in April 22 and below zero since then, but trending back towards zero. The best print since then, May 2024, when we printed 1.5%. Inflation since April 22, in terms of population increase, is also about 1.5% in terms of net number of people in the UK. Zooming out a bit more though, volumes are still, even though we put on 1.4% year on year in July, 1.8% lower than they were in 2019. Now it's probably fair to say the population's about 3.3% larger or something like that. Basic explanations: either people want or need less stuff. My initial feeling there would be, yeah, right, of course they do. Or they're still worse off than they were in 2019, which GDP per capita would support. So much more saving is also going on in 2024 than in 2019. People still have clear concerns, or when they're faced with an actual incentive to save, a positive real interest rate, even after tax, so even after tax and inflation, there's positive savings rate, they will save. And it's 2019 that was dysfunctional from a savings perspective, and that period in that decade of the tens where we had nearly no interest to speak of whatsoever. It's not 2024 that's the dysfunctional year, if we accept we're somewhere back to near normal rates right now. So that's about 5% less in terms of volume of consumption over a 5-year period per capita. Value is a different metric. That's up 18.5% since 2019. But inflation in that same time period is about 23%. So again, in real terms, after inflation, value is also down about 5%. Now, it's a sector growing cautiously but very slowly, but a little bit reminiscent of construction. And I think it's seen the worst of this most recent recession that's been localised in retail sales. It's a bit behind construction, which is now roaring, according to the PMIs, and has a big role to perform as far as the Labour government are concerned in house building, even if infrastructure projects at the moment look to be continued to be put off from the initial Reeves foray. I'm hoping this will turn around because it needs to, and it's a mistake at the moment, but there we go. The average year-on-year growth is about 2% in volume, or has been for the last 30 years or so. So, consumption repair, which will help growth if government spending is to be cut as promised. Remember, government spending and consumption are really the two major components of growth, with consumption coming first by a long way. We need it if we're going to have this growth that the Labour Party keeps talking about. So, on to the private rent and house prices report for August from the ONS. It covers rents for July and house prices for June, so pay attention. It has for the months it's been around. There were very few regular reports on rents before this year, which is typical of these situations. Someone at governmental level noticed we should be paying a bit more attention as a country, and then the ONS was ordered to sort it out. They told a story of two halves: rocketing rents, tepid house prices. Not so more, because whilst rents remain at a pretty eye-watering level of increase, they're up 8.6% year on year for July. House prices also increased by 2.7% in the year to June. The average rent in England is now £1,319 per calendar month. Northern Ireland continues to surge with a 10% year on year rise. The ONS still has London rents leading the charge, up 9.7%, and the North East lagging behind at what's still a chunky 6.1%. There is a note that by bringing things more up to the real-time era, I mean, I know it's the end of August and we're discussing June as far as the house prices are concerned, but still not bad for the ONS. Revisions might be larger than usual, particularly blaming new build prices, which data takes time to come through. But the record high rent rise of 9.2% was recorded in March this year. So we've cooled from there down to 8.6, but cooling slowly is the ONS verdict, and I'd agree with that. And that's absolutely symptomatic of nearly all the big percentage rises in inflation we've seen in other areas. Rents are sticky, as economists say. They go up. When they're rising, they climb slowly, and they will stay up when inflation has gone away, as a rule. 12 months ago, June 23 for the house price index, the year on year was 0. July 23 for the rental increase, the annual increase was still 7.8% back then. So that's 17% in 2 years, which is an average figure, and it must feel crushing for the tenants. Although we should remember wage increases of 13.4% over the same time period, so rents have still gone upwards a few percent in real terms and will be taking a slightly bigger percentage of the disposable income. The price rises at a geographical level start to look really interesting. Yorkshire and the Humber 4.7% up, and the North East also up over 4% year on year. Perhaps one of the areas where buy-to-let has still worked, even at the newer mortgage rates, especially those higher ones that we had last year that we've moved down from now a little happily. The South East will be very pleased to be making a comeback into positive territory though. The only real outlier on the regional figures is the East Midlands, lagging behind at 1.6% year on year. One of the cheaper areas, but not really motoring forward in pricing. The North West continues to perform really well. London's at the bottom of this list with a 0.6% capital growth rate year on year. But nowhere has felt a bigger impact than London for leveraged buyers because mortgage affordability has become a real issue. Still, nonetheless, 0.6 is London's best print since May 2023. When we look at regional rents, the North West again stacks up very well, just behind London. 9.5% increases year on year. The East Midlands does well here, 9.4. North East at 6.1. No other region has gone up less than 7% year on year. So regardless of rent influences in the upcoming Renters' Rights Bill, what's happened has happened, and there looks to be no unwinding of that. London average rent is now £2,114 per month. Spare of thought for renters in Kensington and Chelsea, where the average rent is now £3,411 per month. On the full report, there's data by size, property type, plenty more, but that's enough from me. We can see exactly where we are, still motoring much more than predicted by many, and so estimates of the 6 to 7% rent rises over the next 12 months don't look unrealistic. Probably towards the lower end of that. Let's make sure we check in 12 months' time to check that out. So on to the PMIs then, the Purchasing Managers Indices. The flash composite, the key number, came in on Thursday at 53.4 against the consensus of 52.9. Now 53 and above is healthy economy territory, which we usually associate with about 1.75% growth per year. But the 53 average this year so far has done a little better than that. I think the fast cooling of inflation has helped the GDP figure somewhat falsely in a way, to be honest. The growth forecast from the experts is still coming in at an average of 1.1% per year, which still really irks me given that we're at 1.3% already after the first half of the year, and the third quarter is clearly going quite well. It's ridiculous, really. Get rid of all these stupid forecasters. But then again, who would I have to moan about then? The services flash number was 53.3, again better than expected, and the composite number means that the construction index must have been nearly as healthy as it was last month, where it printed over 55. We don't know the exact number for that because they don't do a flash construction PMI at the S&P. But the tail of the tape from the S&P chief business economist Chris Williamson, he cites stronger economic growth, job creation and lower inflation, absolute Goldilocks scenario for the economy. Business confidence elevated compared to historical standards, hasn't been able to say that for a while. GDP growth should weaken compared to H1, but of course we're not going to do another 1.3% in the second half of the year, otherwise we'd be at 2.7 ish by the time we got to the end of it, and that really would be a massive outlier of a print for a year like this. But he sees this as quarterly growth at about 0.3 where these figures are. I'm sticking with my 0.4% prediction for Q3, but let's see what happens. Services inflation has moderated, although it's still over 5%, remember Chris, and he thinks policymakers will still likely move cautiously on rates. As you can hear, I don't disagree with much of that at all. I thought it was a very good summary, and I don't say that very often either. The gilts and swaps, the 5-year gilt closed Thursday at 3.776 and Friday at 3.726, and the 5-year swap closed Thursday at 3.622. We opened the week at 3.718 on the 5-year, and it was a bit of a tiny up week with little news of consequence. The news of the Ofgem price cap being decided at 10% for October is mildly inflationary, of course. I prefer down rather than up, of course, but we'll take it. Things have very much stabilised in the middle of my range for yields for this year, and I'm very hopeful of a waning of between 0.1 and 0.25 around by the time we get to the end of this year, based on where the rates are at the moment. But 15 basis points of discount for the swap looks almost anomalous between the gilt and the swap. I'm not sure why when you hear what I'm about to say, but this isn't about mortgage money demand at the moment. So, as an aside, I wanted to flag the liquidity drain that is going on after a regular reader sent me a very interesting message this week. This is an argument to slow down on quantitative tightening. Reserves of 700 billion or so do not raise major red flags, but the trend in the chart, which was used as this week's image, is very clear. 38 billion used by banks in the repo overnight market or the 1 week market is clearly a little over 5% of all bank reserves. It's a pretty high number. It's record demand in the repo markets, and while there's some speculation it's not just about liquidity but also some opportunistic bank traders using some arbitrage strategies, it still needs to be flagged up. The bank's own analysis suggests under 490 billion would not be enough money for commercial banking reserves, so there isn't a massive margin of error. Yes, it's 200 billion, but those reserves were 1 trillion in early 2022, and so they're 30% down since then. The Bank of England has an important decision to make next month on quantitative tightening and the pace of it. I've said this many times, but they need to stop the practice of selling bonds at a loss into the secondary markets. All this achieves is unwinding the position more quickly, and there looks to be an element of fragility here, even if they're simply papering over the cracks. Great. On to the chunky stuff then for this week. 2 courses. For the fish course, we have a look at Zoopla's research report, which was published this week about rents, which flies somewhat in the face of the ONS report above, which is exactly why I want to go into it in some detail. And then for the meat, I'm replicating a draft of an open letter I want, with your support of course, to get put in front of Matthew Pennycook, the new housing minister. I'd love critique, support in sharing, and signatures from anyone brave enough to sign as well. Anyone with political connections, this is where I need you. Directors of larger property companies, again, please, can you help? You'll see it's written from a pragmatic point of view. Regular readers and listeners won't expect anything else from me. I take the view that Mr. P et al. Will have little time or sympathy for standard landlord gripes, but instead focus on the high-level, big picture, if sorting out the PRS and the entire housing market of the UK is a real and true goal for this supposedly mission-led government. All feedback is welcomed. I'm also aware I'm positioning myself to be shot at here, not Trump style, you'd hope, and as and when, if we get any traction, if I get some abusive messages, I'll be sure to share them in my normal, good-humoured and broad-shouldered way. Anyway, Zoopla first, and their headline, Rents Start Falling in Major Cities. They report falling rents, that is asking rents, remember, in London, Brighton, Glasgow, Nottingham and Worthing, and 1/3 of London borough rents coming down. They also predict 3 to 4% will be the number for 2024, but again this is a number for new lets, and that's not as important in my view as the number for the ONS, which is including the majority of what the ONS number includes is existing lets, of course. We do need to be very careful to make that distinction, and I also think Zoopla should be more careful to make that distinction as well. But here's where I do very much agree with the report. It says we're past peak rental inflation. We definitely are for asking rents, and almost certainly we are for existing rents too. What could change that? Well, a panic reaction to various bits being drafted in the legislation of the Renters' Rights Bill, of course, if rent controls are to make a surprise appearance, even rent stabilisation, which I actually fancy to be included now, which would really not be that damaging in theory. A lot of people are going to see the thin end of the wedge argument here, and I'm concerned about that. So, Zoopla points to a 39% drop in demand for rented homes over the past year. From a high base, yes, but that's a very significant drop, of course. They categorise it as moving from red hot to hot. I'd probably see it more as moving from white hot to red hot personally, but there we go. 17 people chasing every rental property is still double the number in 2017 to 19. They're also reporting, unlike anywhere else, an increase of rental homes per estate agent of 17% year on year. Again, from a very low base. Richard Donald and his team point to corporate landlord acquisitions, but also lower mortgage rates than 12 months ago, allowing some to transition into ownership. There are still 1/3 fewer rental homes than the pre-pandemic average, and I will again point out about a 3.5% increase or so in the population in that time, a disproportionate amount of whom will be renters. Zoopla's figures are plus 5.7 for the past 12 months, but only plus 1.6 in the past 6 months for new lets. They cite affordability as providing the ceiling. I'm still not convinced of this. I just think inflation has worked its way through like it has with many other goods. But in the south, and particularly London, this will be accurate, of course. I've included a link to the Zoopla newsletter, a research piece in the written version of this blog, which you can see on my LinkedIn or on the Partners in Property website. So, cities with rising rents are a mixture, really, aren't they? There, north, south, expensive, cheap. It's worth a look at the report and the graphs, but be careful how you interpret them, because some of them are over 6-month periods, not 12 months. And then overseas student applications falling off a cliff has been cited as a significant factor, as has a weaker labour market. I'm not so sure about the latter, because there are still more people employed than there were 12 months ago. Zoopla's got the average asking rent in London at £2,172 a month, 70% above the UK average. Zoopla cite more corporate landlords buying in London. I'd like to know the source of that, because the business case looks somewhat weak, although London capital growth has been anemic since before Brexit. So perhaps there's a corporate view that London prices will be on the up and up as rates move downwards. And indeed, I would expect London and the South East to be more rate sensitive than other areas. Another quality piece from Zoopla, really, with only a few pedantic points for me to disagree with, but hopefully a valuable share with the analysis I've also sprinkled in. So, onto the open letter. Without prejudice, please let me know what you think. And I title it, The Private Rented Sector. Private portfolio landlords with 10,000 rental units total or more. That's a group that I'm in, and that's the number of units we're dealing with. Addressed to Matthew Pennycook, the Minister of State for Housing. And it says, Dear Minister, we would like to congratulate you on your appointment to this crucial role. As housing providers in the private sector, we provide housing to millions of people as a fractured and often lambasted part of the system. Yet we understand that we are a crucial part of that system, with roles and responsibilities that can make a real difference to our tenants' lives. We have watched the government's plans with interest and are very pleased to see coherent plans emerging. However, we also feel this moment is one of crucial opportunities and must be seized now or forever missed. The ideas around planning reform, housing target reintroduction, green or grey belt and social and affordable housing all make sense, and all have their own challenges in delivery. Last year, 192,000 new households entered the private sector from outside of the current ecosystem, with a net 22,000 going into the social rent sector and a net 102,000 buying. This was 68,000 more households net in a PRS, which many analysts believe to be shrinking. The source for that is the English Housing Survey 2022-23, which is the government's own data. Hamptons International points to 163,000 rental properties disappearing from the rental market between 2019 and the end of 2023. The single largest factor has been the interest rate. Commercially, the sector is unviable. George Osborne CH, former Chancellor, made a significant tax change in 2015, the amendment of Section 24 of the Finance Bill 2015, and was concerned enough then to phase that in over 4 years. However, in reality, in that period, interest rates continued to fall. They then rose very sharply over a much shorter period of time, and the entire incidence of those changes became very stark. It is highly possible that landlords can be running an unprofitable business and yet still be liable for taxation on profits that don't exist. The result is the same as in any market with supply, demand and consumers. For emotive reasons, housing is not considered thus, but it must be. When the cost of providing the service goes up, the price of the service goes up. Academic literature points to several estimates of the price elasticity of demand for rental housing being around minus 0.6. In plain English, if the price goes up by 10%, the demand only goes down by 6%. In tighter markets, such as the PRS right now, the demand reduction is even less, and much less in the shorter term, as low as 1% reduction in demand, with a 10% increase in pricing. What does this mean? Well, because housing is a basic need, even when the price goes up considerably, demand remains almost the same. Then, when there are major increases in delivering the service in terms of costs, these are therefore in their near entirety passed on to the tenant. No one wants a sector where tenants are becoming worse off. Rents are taking a higher share of household disposable income. Rent controls have wisely been written off as disastrous for the sector, and again the evidence for this is widespread. What's needed is income growth, supply growth and stability, and this is where the opportunity lies. The PRS has grown to fill a void started in 1980 by insufficient social house building to replace right to buy stock, but has also always existed to serve those who need shorter term arrangements than buying a house in our slow, outdated and heavily taxed conveyancing system. Those who move for work for a defined period of time. Those who choose to rent because they manage on a monthly budget but have never saved the buy-in required for a deposit on a home, or simply don't want to run the risks of needing to replace the roof or fixing major structural issues. The work of Mr. Osborne and the previous administration drove landlords out of the sector through commercial means, and also through vilification to an extent. The interest rate in inflationary times, where construction inflation has broadly outstripped the broader measures, at over 40% compared to CPI moving a shade under 25% since 2020, has done even more damage. This private sector has choices. It funds itself on much more expensive credit than the government has available. It takes sensible risks. It prides itself on its product, with significantly higher satisfaction levels than social landlords, 82% versus 74% in the 22-23 English Housing Survey. The capital also has a choice, and many are voting with their feet, retiring from the sector and putting the money elsewhere. Government bonds and similar now, once again, have a real after-inflation return, a phenomenon not seen for around a decade and a half. The early rhetoric is around support for EPC measures to be introduced. We would implore certainty around these comments and policy guidance, because loose lips will drive more out of the sector. The idea of a flat contribution required from a landlord who has a property or small portfolio in the northeast, for example, contributing the same to energy efficiency as a landlord in central London is unrealistic and could lead to large sell-offs in already deprived areas of the UK, which have very long social housing waiting lists. Many options will be considered, including government grant schemes, we're sure, but if that's the case, early communication on this would be highly recommended. We actively want and need for all concerned to provide good quality, appropriate, flexible and safe dwellings for those that we house. We support rogue landlords being driven out of the sector and wish that the myriad laws that already exist were enforced properly before introducing another raft. We would welcome the opening of a dialogue around energy efficiency and carbon footprints, how and when. Sensible grounds for possession whilst providing security of tenure. Access to funding for improvement of existing homes. Methods to ensure tenants, where desired, have access to buy existing rentals without any of the stakeholders losing out. And also taxation in the sector and the incidence on all stakeholders. We would welcome the opportunity to engage at your convenience, signed, whoever we can get to support us. So, remember to let me know what you think, like, share, comment, print or send an email to your local MP, and please feel free to tell me where I've got it wrong. And don't forget, you can still book your early bird tickets for the 4th Property Business Workshop of the year at bit.ly/PBWFOUR, and that's taking place on Tuesday the 1st of October in central London. Now, there's only one way to deal with all of this continual noise and the unfolding chapters of our new dawn, and that is, of course, keep calm, always listen to the supplement, and carry on. Thank you.